Welcome to Talk Tickers, your direct line for the key insights from the latest earnings calls. Today, we're doing a deep dive into United Airlines Holdings Q2 2025 conference call. Our mission, as always, is to cut through the noise for you, pull out the essential takeaways, and really give you a clear view on their performance and what's coming down the track. Let's jump right in.
Absolutely. So United reported earnings per share EPS of $3.87 for the second quarter. Now, this was right in their guidance range and actually ahead of Wall Street's expectation of $3.81. And what's really interesting is management said, look, if it wasn't for all that disruption at Newark, the EPS would have actually beaten the high end of their own forecast.
That's a pretty strong signal, isn't it? Especially considering the challenges. And it wasn't just EPS, right? Revenue was up too.
Yeah, total revenue climbed 1.7% year over year, hit a record $15.2 billion.
Okay, record revenue. But how did that look on a per-seat basis? Those TRASM and CSM numbers are always key in this industry.
Right. So consolidated TRASM, that's total revenue per available seat mile, was down 4%, but capacity was up almost 6%, 5.9% to be exact. Yeah. Crucially, though, if you adjust for Newark, that TRASM dip would have been much smaller, maybe 2 to 3%.
Okay, so Newark really skewed that metric. What about costs? CSM ex fuel.
CSM, its growth was strong, just 2.2% in Q2. Shows good cost discipline. And they generated over $1.1 billion in free cash flow. Pretty solid.
Wow, okay. And liquidity looks good too.
Very good. Ended the quarter with $18.6 billion, and that includes their $3 billion undrawn revolver. So plenty of cushion.
So summing up the financials, beat expectations despite headwinds, record revenue, decent cost control, strong cash flow, and liquidity. Sounds like management felt pretty good overall.
Definitely. You got a sense of pride in navigating the challenges, confidence in the strategy, and real optimism despite those initial issues, especially at Newark.
Right. Let's dig into Newark. They called it a perfect storm. What exactly happened there in Q2? What caused all the trouble?
It really was a perfect storm scenario. You had a combination of things hitting all at once. There were these FAA technology outages, plus ongoing runway construction and FAA staffing shortages. All that together just led to major cancellations, significant delays. It really hit them hard operationally there, caused a lot of book away, as they call it, customers choosing other options.
Ouch. And that must have had a real financial impact then.
Oh, absolutely. It knocked about 1.2 percentage points off their Q2 margins. And they do expect a bit of a hangover, maybe a 1-point impact, still lingering in Q3 from that.
Okay, so a real hit. But you said they sounded optimistic. Did things turn around?
Dramatically.
Yeah.
This is the impressive part. Bookings have apparently largely recovered already, and they're not expecting any impact by Q4. In fact, get this. By June, United's operation at Newark actually had the fewest cancellations and the most on-time flights of any New York area airport.
Seriously, after all that, that's quite a comeback. How did they pull that off? Was it just things getting back to normal, or did they actively fix things?
No, it wasn't just waiting it out. Several key things happened. The runway construction finished 2 weeks early, which helped massively. The FAA got those fiber optic upgrades done, moving away from the old copper wires. United had been pushing for that, by the way.
Infrastructure improvements.
Exactly. And maybe the most critical piece, the FAA finally put in hourly flight caps. This stops the airport being scheduled beyond what it can actually handle. United said they'd been advocating for this kind of capacity discipline for over a decade.
So better tech, finished construction, and smarter scheduling limits. Makes sense. And United played a role in funding those upgrades, too.
Well, they certainly advocated for the funding. They mentioned the $12.5 billion Congress approved for air traffic control infrastructure, specifically highlighting the move to fiber optics. Shows they're trying to influence the system, not just react.
That Newark turnaround is definitely a testament to their operational chops. But was that resilience just isolated to Newark, or is the whole system running well?
It seems broader. Overall, the United operations performing really strongly. They rank second in on-time departures among the top 8 U.S. carriers. And this is while flying in some of the most congested, toughest markets globally.
That's significant. And handling record passenger numbers too, right?
Yeah, they hit their busiest travel day ever back on June 22nd, over 611,000 people. Despite that volume, they achieved one of their lowest Q2 seat cancellation rates in history. And customer satisfaction scores, NPS, were the highest for Q2 since before the pandemic.
Okay, so operationally, they seem to be firing on most cylinders, even with the Newark blip. Let's shift gears a bit to the strategic view. They mentioned some demand weakness earlier in the year.
They did. Initially, demand was running about 5 points weaker than they expected. They put it down mostly to uncertainty. The tax situation here, geopolitical stuff in the Middle East, tariffs, just general economic jitters weighing things down.
But has that changed? Did they see improvement?
Yes, significantly. They described a meaningful inflection point in demand. Basically, as some of that uncertainty started to fade, booked revenue really picked up. They highlighted a double-digit acceleration in business demand, specifically citing the first 3 weeks of July data. That's very recent and very positive.
Double-digit acceleration in business. That sounds like a big shift.
It is. And they also noted domestic ticket sales are now showing positive year-over-year yields for the first time since February. So things are definitely looking up on the demand front.
And they use this phrase, deja vu, all over again, comparing the current situation to last year. What's the parallel they're drawing?
The parallel is with industry supply. Just like last year, weak industry RSM, that revenue per seat metric we talked about, is leading other airlines to start cutting capacity, particularly domestically, starting around mid-August.
So supply discipline kicking in again.
Exactly. Last year, those cuts led to improved margins and a strong run for airline stocks. They seem to be suggesting a similar dynamic might be playing out now.
Interesting. It implies maybe a more rational industry approach to capacity.
That's the hope, right? That carriers are getting better at matching supply to actual demand rather than just flooding the market. It suggests a potentially healthier environment overall if it holds.
Now, within United's own performance, international continues to be a bright spot compared to domestic, right? That diversification seems key.
Absolutely key. International RAS was only down 1%. Whereas domestic was down 7%. That's a huge difference. And the Pacific routes actually saw positive RAS growth.
Wow. And premium cabins are still leading the charge?
Definitely. Premium cabin revenues were up 5.6% year over year. And the RASM for premium seats was a full 6 points better than non-premium. So naturally, they plan to further lean into premium. They mentioned the new Polaris Studio Suite coming and the United Elevate interior on the 787-9s, which will pack in 99 premium seats.
99 premium seats on one plane, that's a lot.
It is. They specifically called out Premium Plus, that cabin between regular economy and the lie-flat Polaris seats, as a really exciting growth area for them.
Makes sense. What about other revenue streams? Cargo, loyalty.
Both strong. Cargo revenue was up 4% on record volumes, showing that freight business is doing well. And loyalty revenue, mostly MileagePlus, was up a healthy 9% in Q2. These are important parts of that diversification strategy, less reliance purely on ticket prices.
And this all ties back to their big United Next strategy, which they argue is creating a healthier industry. What's the core idea there, this concept of two dominant airlines?
Yeah, the core thesis is basically this. The industry is fundamentally changing. They see it consolidating around two brand-loyal, revenue-diverse airlines themselves and Delta. They believe these two are gaining market share and will capture most of the industry profits because they have advantages that are, in their words, structural, permanent, and uncopyable.
Uncopyable advantages?
Part of it is cost convergence. They argue it's getting harder and more expensive for low-cost carriers to operate effectively at the big, congested, high-cost airports where United and Delta have strong hubs and slots. So the industry is naturally shifting, they think, towards airlines focusing where they have real advantages and pulling back where they don't. Basic economics really playing out.
So it's less about just being the cheapest and more about network loyalty, premium offerings in those key markets.
That seems to be the argument. Value and loyalty over pure lowest cost, especially for the business and premium traveler.
It's a compelling narrative for them. But what's the biggest potential risk? Could that industry discipline on capacity just evaporate if demand stays strong?
That's always the risk, isn't it? If competitors, especially low-cost ones, decide to chase market share aggressively again with lots of new capacity, it could definitely pressure revenues for everyone.
Or a big economic shock hitting that premium demand they're leaning into.
That too. A major recession impacting business and high-end leisure travel would hurt them, given their strategy. But they seem confident their model is more resilient now.
Okay, so what specific things are they doing now to drive this United Next strategy forward? Fleet, network moves.
Well, resuming Tel Aviv service, starting from Newark soon, shows their global reach focus. Domestically, it's about building connectivity through their hubs. And a huge piece is upgauging the fleet, flying bigger planes.
Right, the MAX 9s, the A321neos.
Exactly, larger narrow-body jets. And the key there isn't just more seats, it's more premium seats per departure.
Ah, tying back to the premium focus. Helps bridge the gap between domestic and international margins.
Precisely. Bring that premium experience to more domestic routes.
Yep.
They also mentioned the JetBlue partnership, Blue Sky, and their planned return to JFK Airport in 2027.
Got it. And connective media, that ad business using seatback screens.
Yeah, they're aiming to double its revenue this year compared to last. Getting Starlink Wi-Fi up and running reliably on more planes, they said 60 regional jets are good to go now after fixing some static issues, is key to growing that faster in 2026 and 2027. Still small, but growing.
Okay, we've hit operations and strategy. Let's switch to the financials again, the outlook. What are they guiding for Q3 and the full year?
For Q3, the EPS guidance is $2.25 to $2.75. For the full year, they're guiding $9 to $11 per share. And this is important, management went out of their way to call that full year range conservative.
Conservative, meaning they think they can beat it.
That was the strong implication. They said there's significant potential upside if these current demand trends, like the double-digit business surge, hold up. Plus, remember the industry capacity cuts. They expect those to continue beyond September, which gives them more confidence for Q4 and maybe pushing towards double-digit pre-tax margins down the line.
Interesting. And is there a difference in how Q3 and Q4 might feel revenue-wise?
Yeah, a bit of a nuance there. Q3 RASM is likely still negative year over year. Why? Because Q3 tends to rely more on leisure travel, especially international shoulder season stuff, and main cabin sales, which have been the weaker spots.
Okay.
But Q4 typically leans more on domestic business travel and premium demand, exactly the area showing that strong recent inflection. So Q4 looks potentially much stronger from a revenue perspective.
Got it. Back half weighted towards Q4 strength. What about costs going forward? Can they keep that CSMX discipline, especially with new labor deals?
They expect similar CSMX performance for the rest of the year, including the impact of the new flight attendant contract. They attribute this to a few things. Running a reliable operation just costs less, savings from procurement, better inventory management, and also more people booking direct, which lowers distribution costs over time.
Makes sense. And the balance sheet. They've been working hard to repair that post-pandemic.
Huge focus there. Besides the strong liquidity and cash flow, the big news was paying off the last $1.5 billion of their MileagePlus bonds 2 years early.
Why is paying off those bonds specifically such a big deal?
Because MileagePlus is their loyalty program, arguably their most valuable asset, a cash-generating machine.
Mm.
Those bonds had liens on it. Paying them off fully unencumbers that asset.
Meaning it's totally free and clear now.
Exactly. They now have over $40 billion in unencumbered assets with MileagePlus as the crown jewel, completely free. Gives them massive financial flexibility. Their goal is to get net leverage below 2 times. They're clearly marching towards wanting an investment-grade credit rating again. They've cut gross debt by nearly $11 billion since the peak.
And how are they balancing that debt reduction with returning cash to shareholders, buybacks?
They did buy back $235 million in shares in Q2, average price around $66. Still have about $829 million left on their authorization. So they're doing both paying down debt and buying back stock. They expect free cash flow to really pick up in 2026, 2027, which will give them more firepower for both.
Okay, final check on the hardware fleet deliveries and supply chain stuff. Any issues there?
MAX deliveries from Boeing are actually running slightly ahead of schedule, which is good news for them. But the 787 wide-body deliveries are still behind plan, and engine components are still a bottleneck for the whole industry, not just United.
So the upgauging plan is still on track despite that?
Yes. They expect average aircraft size gauge to be up 2% in 2026 and speed up in 2027. They're still hoping for MAX 10s in 2027, but they have a backup plan using MAX 9s if the 10s are further delayed, just to keep that upgauging strategy moving.
And pilots, staffing levels, okay.
They said pilot hiring is balanced right now, not over or understaffed, hiring about 3,000 pilots a year.
Okay, that feels like a really thorough overview of the call. Covered a lot of ground. Now it is time for our segment, This Is Not Financial Advice, where we toss out an outrageous but plausible trade idea based on what we just heard. What do you got for us today?
All right, here's the thinking. You've got management explicitly saying their $9-11 full-year EPS guidance is conservative. They just saw, literally in the last few weeks, a 6-point positive swing in sales and that double-digit acceleration in business demand. You layer on top of that the deja vu scenario, industry capacity cuts starting again, which historically boosted margins, and United's own argument about their structural advantages as one of those brand loyal carriers.
Okay, setting the stage, what's the play?
The outrageous but plausible idea is this. Consider a long position in out-of-the-money call options on United, maybe expiring sometime in early 2026.
Out of the money calls. So a leveraged bet on significant upside.
Exactly. The logic is that the market might not have fully digested or priced in just how strong this demand recovery could be, especially if that industry capacity discipline holds like it did last year. If things play out the way management seems to hope, and potentially better than their conservative guidance, there could be a significant upside surprise. These options offer a way to potentially capture that nice runoff in stock price they hinted at, echoing last year's setup. It's betting on the optimistic scenario really coming through.
A bold idea, playing for potentially significant upside based on management's own cautious optimism and the current market dynamics. Definitely food for thought. So, to wrap up our deep dive today, United's Q2 showed impressive resilience, especially the Newark recovery. There's a clear, recent, and strong positive turn in demand, particularly business travel. And strategically, they feel they're positioned extremely well in an industry that might be fundamentally changing.
Yeah, and underpinning all that is disciplined financial management. They're strengthening the balance sheet, paying down debt, freeing up assets like MileagePlus, while still returning cash to shareholders. The narrative is very much about long-term, sustainable profitability and leveraging what they see as permanent advantages.
Absolutely. Now remember, everyone, this discussion was purely for informational purposes. It is definitely not financial advice. We really encourage you to take these themes, think about them, consider what these potential long-term shifts in the airline industry could mean for the market, and maybe even for your own travel plans down the road.